taking a look at the Viridian Cannabis deal tracker, checking out deal flow, where money's going, either acquisitions, mergers, loans, all that good stuff, transactional activity in general.
It's only entertainment.
Welcome back to the Talking Hedge. I'm Josh Kincaid, capital markets analyst and host of your Cannabis Business Podcast. We saw that there were 5 fewer transactions and $254 million in lower volume than the previous week. So compared to last year's same week, 7 more transactions closed with 192 million higher volume. Average deal size, 21.6 million versus 700,000 last year. Overall deal activity was thin. Both equity and debt issuances is dominated by a single issue. There were 6 equities that were closed for a total proceeds of 66 million. Approximately 50 million of the total was funds raised by AYR Strategies through a warrant exercise. 3 debt issues closed for a total proceeds of 128 million, led by the 120 million Verano Holdings credit facility upsizing. We also saw some cannabis stocks drift slightly lower for the week, measured by the Advisor Shares ETF, which is down 45% from its February peak. They must not be using automated algorithmic trading because our cannabis ETF is our cannabis fund portfolio rather is up over 100% over the last 52 weeks. So, but for the second week, there's tier 1 multi-stat operators hit the hardest. So Ascend Wellness down almost 10%. TerraSend was down 7%. So some big gainers and losers. Harborside was down 50% year to date. Tilray is up somehow. Organogram is up 75%, which I like. They've got some automation. Hexo, I like their automation too, but Hexo's got a lot of debt. I don't know anything about Organogram's management either. I'm looking at anybody in Canada who's got automation because everybody else is going to fail. I don't know if Aurora and Canopy Growth are done writing off as much as they have. Some of these other companies like Lowell Farms, they started out super, super sketchy. A lot of their deals out of California went bad with the pre-rolls and the lounges and everything else. Consortium up 9%, but it's 5 digits ending in F. So I want to make sure that they're DTC eligible, that they have a licensed active individual that's able to take in their stock certs. And looking at total capital raised year to date in 2021, 10.6 billion is now approximately 0.34 billion lower than the same period in 2019, but U.S. capital raises are a lot more robust. So U.S. equity raises, they're up 828 million, or that's 21% of the U.S. debt raises compared to 2019. So Canada's off sharply. Equity raises are down 48%, and debt is down 17%. One of the largest equity raises happened on October 20th with Air Wellness, 6th largest MSO by market cap. They have the lowest valuation in the group, but they also have the highest 2021 to 2023 expected revenue growth. So AR Management believes its stock is undervalued, that the company's board approved a plan to repurchase 5% of the shares. I mean, I don't understand this. 40% of the whole bull market that we're seeing as a result of stock buybacks. So do we really want to incentivize CEOs short-term need to get their bonuses? That's all stock buybacks are. Yes, short term your price goes up, but shit, aren't you investing so that the company can do something with it instead of writing money off like Aurora and Canopy and soon to be Air? Like, if you're buying stock back, get out of here. That's crazy. Massive red flag to me. Look at public company listings. 7 of the 9 companies that raised capital were public. All 7 trade in Canada. 5 on the Canadian Stock Exchange and 2 on the Toronto Stock Exchange, and all 7 trade in the US, 6 on the OTC and 1 on NASDAQ. Equity versus debt raises. Equity was accounted for 6 of the 9 raises and 34% of the capital raise. So that's interesting. That's only 34% of the capital. So that means a lot more people are going for debt. So they don't believe in the current valuations and or being potentially diluted from future warrants or stock issuance. So they're going to go after tangible property, plant, and equipment on the debt side. So that tells me that there's a lack of trust in some of the management and or current valuations. So that's going to be interesting to see how that rolls out. The largest, most interesting debt deal happened on October 20th with Verano announcing it added an upsize to its senior secured term loan, 250 million, adding an incremental 120 million. It's 8.5% interest rate, so it's not bad. 18-month maturity, that's pretty soon. It's a senior secured. They have an option for an additional 100 million in term debt at the same term. So I mean that's not bad. It could be a lot worse. So illustrative of the deal, declining effective cost for debt in large MSOs. They're not having to borrow at high rates anymore. So continuing the downward trajectory that Viridian pointed out for the cost of capital. So reducing cost of debt in stark contrast to the reception the group has seen in equity markets, where the prices have declined by 45% from the February peaks. The decline in debt costs result from improvement on issuers' credit quality and increased presence of well-funded institutional lenders like the participants that have funded some of these deals. So within just this year, we kind of seen prices almost cut in half. I'm curious if that's more of a result of so much money being printed from quantitative easing and people needing just to throw it somewhere, and the US is the cleanest dirty shirt in the room. Canada is way too overvalued and no one else has a regulated marketplace, so you're not really sure if you're going to get your money back. So the rates are getting cheaper because there's so much capital. I find it interesting that just in like 9 months, basically the rate is half of what it was. So, I mean, that's good, um, you know, but I think there's also some side effects to that. And I don't think that it's going to be permanent. I think prices are going to keep going lower and lower as cannabis becomes more and more normalized. Um, but I don't think this is going to be available to everybody. I think that would be unrealistic to even assume that. So there's some evidence that the market is rationally pricing the credit quality of these multi-state operators. So looking at the effective rates of recent transactions against the issuer's credit ranking, we can kind of see that Jushi is a little bit higher in price versus True Leave, who might have more property, plant, and equipment. Jushi is newer than Cresco, who may have more licenses and collateral. So maybe more comprehensive look at the credit quality of Verano relative to other public MSOs with a $750 million market cap. Verano ranks as a third best credit of the group based on the information available, consistent with the pricing of its upsized credit facility. Verano is the second lowest debt to market cap of the group and the highest consensus for their EBITDA. So Viridian is expecting to see a continued debt issuance from these multi-state operators or MSOs. They're going to try and build out newly acquired licenses and pursue that accretive acquisition. How they're going to do that with, people going delivery, bypassing some of these rec shops, and you're buying commercial prices at all-time highs when people aren't really going into work and traveling. So I'm curious if this is the wisest move for MSOs. We'll see. Looking at capital raised by sector, 5 of the week's 9 capital raises came from cultivation and retail. So obviously retail is still there, but getting that vertical integration for seed to sale. Looking at mergers and acquisitions, so there's only 2 closed M&A transactions compared to 3 in the previous year period. Viridian, they've chronicled 265 transactions year to date in 2021 compared to 71 last year. Public companies were the buyers 85% of the time this year versus 89 last year. So pretty spot on. 186 US targeted M&As year to date, with a record 8.3 billion in total consideration. That's cash and stock. So both transaction numbers and total consideration exceeded the values recorded in each of the last 2 full years. One of the key drivers of the M&A wave has been increased deal sizes. So when you look at the price consideration for non-cultivation year to date, it's 2 times all of the previous full year amounts. So people are definitely going after brands and multi-state operators, trying to grab what they can. So it looks like there's a bit of a frenzy out there. The largest M&A deal came from Innovation Industrial Properties, IIPR, the first and only New York Stock Exchange listed company focused on U.S. cannabis industry. They closed an acquisition of a 200,000 square foot facility in California. The purchase was $51 million, with an additional $9 million allowance for improvements used as a cultivation processing facility for a vertically integrated company called Gold Flora. High Tide was another interesting one. $286 million market cap, retail focused Canadian company. Looks like a leading online retailer of hemp-derived CBD products in the UK. Total consideration is $5.8 million, with an additional $6.7 million in stock. So looking at public versus private acquisitions, both of the week's 2 acquisitions were made by public companies, and the mergers, buyers and sellers in the deals were from the following sectors: cultivation and retail for the acquirer, as well as retail. The targets were hemp and cultivation and retail companies. Definitely a lot of companies out there trying to raise capital, some better than others. Most of them are generating revenue. So if you're out there looking for capital, make sure that you're already generating revenue, because pre-revenue pitch decks do not fly well in the face of investors in this day and age right now. So plenty of people out there needing money, looking for money, and we will continue to showcase Viridian Capital's deal tracker for mergers, acquisitions, any and all transactions for US and Canada. Come back to the Talking Hedge for all your needs. With that, we're going to roll this one up. I'm Josh Kincaid. This is the Talking Hedge. Don't forget to like, share, and subscribe, or don't, and I'm out. Don't forget to smash that like button on your way out and check out these other videos that we've got.